There's a question that haunts every person who has ever put a single dollar into the stock market. It's a quiet whisper that can turn into a deafening roar. It keeps people up at night, refreshing screens in the pale blue light of their phones. The question isn't, what should I buy? We are bombarded with answers to that every single day. The news, the gurus, the hot tips from a friend of a friend. No, the truly paralyzing question, the one that separates amateur speculators from professional wealth builders, is far more difficult. It's when do I sell? When is it finally time to let go? Do you sell when the price doubles to lock in those hard-won profits? Do you sell when it falls by 20% to cut your losses before they get worse? Or do you just hold on, praying for a comeback? The confusion surrounding this single decision is the primary source of investor failure. It's where emotion hijacks logic, and where fortunes are lost, not because the initial investment was wrong, but because the exit strategy was based on nothing more than fear or greed. Yet there is one man who seems to exist on a different plane, immune to this universal anxiety: Warren Buffett, the architect of the Berkshire Hathaway empire. We all know his famous advice: our favorite holding period is forever. We've seen the charts of his multi-decade investments in companies like Coca-Cola and American Express, compounding into incomprehensible fortunes. This has led to a dangerous myth, a gross oversimplification of his strategy. The myth is that Warren Buffett never sells, that he simply buys a stock and forgets about it. But that isn't true. He does sell. It's rare, but it happens. And in the story of those rare sales lies the most valuable investing lesson he can teach us. It's a lesson that has nothing to do with taking profits or cutting losses. It has nothing to do with the stock price at all. It is the final promise he offers to any serious investor. A clear, simple, and unwavering rule for when it is finally time to let go. This isn't just a stock market tip. It is a fundamental rewiring of your financial brain. A shift from being a nervous ticket holder in the market casino to becoming a calm, rational, long-term business owner who only dissolves a partnership when the partnership itself is broken. And once you understand this single powerful rule, the noise of the market will fade away, and the paralyzing question of when to sell will finally, and forever, be answered. To truly internalize this framework, we must first tear down the very foundation upon which most people build their investment strategy. We must destroy the idea that you are buying a stock, a little flickering symbol that bounces up and down on a screen. This is the root of all panic decisions. Buffett's first and most crucial mental leap, the one that precedes all others, is the absolute conviction that when you buy a stock, you are buying a fractional ownership stake in an actual, operating business. You are not a trader, you are a business owner. This isn't just a semantic game, it is a profound identity shift that changes every subsequent decision you make. It is the bedrock of his entire investment strategy, and the only way to insulate your portfolio management from the madness of crowds. There is no better illustration of this foundational mindset than his investment in the Washington Post Company, a decision made in the crucible of national turmoil, one that tested his resolve and proved that owning a business is a world apart from renting a stock. The year was 1973. The United States was in a state of profound agitation. The Watergate scandal was metastasizing, a political cancer that was consuming the Nixon administration and shaking the public's faith in its institutions. The stock market was a disaster, mired in a brutal bear market that would last for 2 years, ultimately carving valuations in half. Fear was everywhere. And in the middle of this chaos, one of the companies at the very center of the storm was the Washington Post. Its reporters, Bob Woodward and Carl Bernstein, were the ones breaking the stories that were bringing down a president. As a result, the company and its publisher, Katharine Graham, were under immense political pressure. The Nixon administration was openly hostile, threatening the company's valuable television station licenses. Wall Street was terrified. The stock price of the Washington Post Company was collapsing, falling from a high of over $30 to under $20. To the average investor looking at their screen, the Washington Post was toxic. It was a stock embroiled in a political firestorm during a stock market crash. It was, by all conventional wisdom, an untouchable asset. But Warren Buffett wasn't a conventional investor. He wasn't looking at the screen, he was looking at the business. He saw something that the panicked market was completely ignoring. He saw that the Washington Post wasn't just a newspaper, it was an institution. It owned Newsweek magazine, several television stations, and most importantly, it had a virtual monopoly in its market. It was the dominant source of news and advertising in one of the most powerful and affluent cities on earth. In his mind, this was a fortress, a business with a deep, durable competitive advantage, what he would later call a, quote, moat. He understood that the political storm, however intense, was temporary. Presidents come and go. Market crashes come and go. But the enduring power of a dominant local newspaper and its broadcast stations was a long-term economic franchise. So while others were panic selling, Buffett was calmly buying. He invested over $10 million, accumulating a massive stake in the company, eventually becoming its largest outside shareholder and a director on its board. He wasn't buying the stock, he was becoming Katharine Graham's business partner. And then, the test began. The stock continued to languish. The political pressure intensified. The market kept falling. A typical stock watcher would have been tortured. They would have seen their investment decline, read the scary headlines, and sold in a panic, concluding they had made a terrible mistake. But Buffett did nothing. He wasn't measuring his success by the daily quote of the stock. He was measuring it by the health of the business. Was the Post still the #1 paper in D.C.? Yes. Were advertisers still lining up to buy space? Yes. Were the television stations still the most watched in their markets? Yes. The fundamental story of the business he had bought into remained not just intact but powerful. The stock price was simply Mr. Market, his famous allegory for the irrationality of Wall Street, having a nervous breakdown. He ignored the noise. He held on, not for months, but for decades. That $10 million investment, made in the depths of fear and uncertainty, would eventually be worth over $1 billion. It became one of the foundational investments of Berkshire Hathaway, a testament to the staggering power of thinking like a business owner and holding on through the storm, as long as the business itself remains sound. This story reveals the deep psychological wiring that Buffett has mastered and that most investors fall prey to. The two primary cognitive biases at play here are myopic loss aversion and the availability heuristic. Myopic loss aversion is a powerful phenomenon documented by behavioral economists. It states that we feel the pain of a loss roughly twice as intensely as we feel the pleasure of an equivalent gain. Furthermore, the more frequently we check our portfolio, the more likely we are to see temporary losses, and therefore, the more pain we experience. This myopia, or short-sightedness, leads to a massive overreaction to short-term volatility. The investor who checked their Washington Post stock every day in 1974 felt a cascade of pain, making them desperate to sell just to make the pain stop. Buffett, by focusing on the long-term business, effectively zoomed out, viewing the short-term price drops as irrelevant noise, thus avoiding the psychological sting of loss aversion. The second bias is the availability heuristic. Our brains tend to judge the likelihood of an event by how easily we can recall examples of it. In 1973, the available information was all negative. Watergate, Nixon's threats, a crashing market. This torrent of readily available, scary information made the idea of a permanent decline in the Post's fortunes seem overwhelmingly probable. Buffett bypassed this bias by deliberately seeking out information that wasn't readily available. The company's long-term financial statements, its competitive position, its market share data. He replaced the loud, available, and emotional information with the quiet, boring, and rational data about the business itself. This is a conscious act of mental discipline. He starves the part of his brain that feeds on fear and noise, and feeds the part that thrives on business facts and long-term perspective. So how can we, as individual investors, apply this foundational mindset? The key is to create a system that forces us to act like a business owner, instead of a stock speculator. We can call this the business owner's journal, a tangible blueprint for implementing Buffett's thinking. Step 1. Before you even consider buying a single share, you must physically write down your business thesis. Get a notebook, open a document, and write the words, "I am becoming a part owner of Company X because," and then finish that sentence. This cannot be "because the stock is going up" or "because I heard a good tip." It must be a business reason. For example, I am buying Coca-Cola because it has a globally recognized brand that allows it to charge a premium for a simple product, a distribution network that is almost impossible to replicate, and a long history of returning cash to shareholders. This act of writing crystallizes your thinking and creates a permanent record of your original, rational intent. Step 2. In that same journal entry, you must identify 3 to 5 key business metrics, not stock metrics, that prove your thesis is correct. For Coca-Cola, this might be global case volume growth, operating margins, and return on tangible capital. It is not the stock's P/E ratio or its 50-day moving average. These are the vital signs of the business itself. Step 3. Schedule a quarterly business review for your investment. Put it on your calendar. During this review, your sole job is to check on those 3 to 5 business metrics. You are explicitly forbidden from looking at the stock price during this review. You are acting as a board member, reviewing the operational performance of your company. Step 4, and this is a powerful mental exercise. Whenever you feel the urge to sell because of market volatility, you must ask yourself one question. If I had inherited the entire company this morning, free and clear, would I sell the whole thing today based on this news? The answer is almost always a resounding no. You wouldn't sell a wonderful, profitable business just because of a temporary market panic or a scary headline. This system forces a shift in identity. It creates a firewall between the rational business analyst and the emotional market participant that lives inside all of us. Now let's look at the opposite of this approach, the path that 99% of people take, which we'll call the path of the ticker watcher. This individual sees investing as a game played on a screen. Their primary tool is a smartphone app with a watch list of stocks that flash green and red. Their day begins by checking the pre-market futures and ends with a late-night check of their portfolio's value. Their emotional state is directly tied to these colors. Green means they are a genius, a savvy market operator. Red means they are a fool, filled with anxiety and regret. They buy a stock based on a flimsy story, a new technology, a charismatic CEO, a recommendation from a financial news channel. They don't write down a thesis. Their thesis is just a vague hope that the price will go up. When the market drops 10%, as it inevitably does, their entire worldview is shattered. They have no anchor, no business fundamentals to hold on to. All they see is the red number on the screen, representing their loss. The pain of myopic loss aversion kicks in, amplified by the scary headlines being pushed to their phone, triggering the availability heuristic. They sell. Not because the business has changed, but because the price has. They sell at the point of maximum pessimism, crystallizing a temporary paper loss into a permanent real one. Then, when the market recovers, they are left on the sidelines, waiting for the perfect time to get back in, which of course never arrives. Their portfolio management is a chaotic series of emotional reactions to noise, a process guaranteed to lead to underperformance, high taxes from frequent trading, and immense stress. They are not investing, they are gambling with extra steps. The direct financial connection between these two mindsets is stark and quantifiable. The ticker watcher's constant activity creates immense frictional costs that decimate wealth building. Every time they sell, they are likely subject to transaction fees. If they've held the stock for less than a year, any gain is taxed at their ordinary income tax rate, which can be significantly higher than the long-term capital gains rate. This tax drag is a massive, often underestimated penalty on hyperactivity. But the greatest financial cost is the interruption of compounding. The business owner, by holding the Washington Post for decades, allowed the company's profits to be reinvested and grow, and the value of their ownership to compound year after year, uninterrupted. The ticker watcher, by selling in a panic, not only realizes a loss but also resets their compounding clock to zero. Imagine a simple chart. Investor A, the business owner, invests $10,000 in a great company that returns an average of 10% per year. They do nothing for 30 years. Their initial investment grows to over $174,000. Investor B, the ticker watcher, invests in the same company, but panics and sells during two major market downturns, crystallizing losses and then waiting a year to get back in. Their final sum might be less than half of Investor A's, even though they invested in the same asset. The difference wasn't skill, it was temperament. It wasn't about picking the right stock. It was about having the right mindset. The financial advantage of being a business owner isn't just a small edge. It is the entire game. It's the only way to harness the true power of long-term investing and build life-changing wealth. Once you have adopted the core identity of a business owner, the next logical step is to define the precise conditions under which you would dissolve that business partnership. A business owner doesn't sell a profitable, healthy enterprise. That would be absurd. They sell only when the business itself is no longer the great enterprise they initially invested in. This brings us to the heart of Buffett's selling rule, the broken story trigger. You don't sell when the price falls. You sell when the fundamental, long-term story of the business has been permanently broken or impaired. This requires a cold, rational assessment of the business, completely divorced from the stock's recent performance. It is an admission that your original thesis was wrong, or that the world has changed in a way that invalidates it. And the most painful and instructive example of this principle in Buffett's own career is the story of Dexter Shoe Company, an investment he openly calls his greatest mistake, not just because it lost money, but because he used Berkshire Hathaway's own precious stock to buy it. In 1993, Warren Buffett was on the hunt for businesses to add to the Berkshire Hathaway portfolio. He found what he thought was a gem in Dexter Shoe, a company based in Maine that had been making high-quality, American-made shoes for decades. It had a strong brand, a history of consistent profitability, and a salt-of-the-earth management team. On the surface, it looked like a classic Buffett business. He believed Dexter had a durable, competitive advantage, a moat that would protect its profitability for years to come. He was so confident in this assessment that he paid $433 million for the company, and he didn't use cash. He used Berkshire Hathaway stock. This meant that the former owners of Dexter Shoe became major shareholders in Berkshire. At the time, Buffett wrote to his new partners, assuring them of the bright future of their combined enterprise. The story he had constructed in his mind was clear. Dexter was a great American business with an enduring franchise that would continue to generate solid earnings under the Berkshire umbrella. But almost immediately after the acquisition, the story began to crumble. The world was changing faster than Buffett had anticipated. The competitive landscape for footwear was being radically altered by the rise of low-cost overseas manufacturing. Companies like Nike were building massive global supply chains, producing shoes in Asia for a fraction of what it cost Dexter to produce them in Maine. Dexter's perceived moat, its reputation for American-made quality, turned out to be a shallow ditch, easily crossed by consumers who preferred the style and lower price points of imported athletic shoes. The company's profits began to evaporate. Buffett and his partner Charlie Munger watched in dismay as the durable competitive advantage they thought they were buying was systematically dismantled by global market forces. The business was fundamentally broken. The story was shattered. And this is the critical point. Buffett's decision to effectively write off the investment in his mind wasn't triggered by a stock price. Berkshire owned the whole company. It was triggered by the cold, hard business reality. The profits were gone, and they weren't coming back. He had made a mistake in his initial analysis. He had misjudged the durability of the company's moat. In his 2007 letter to shareholders, he admitted the error with brutal honesty, calculating that the Berkshire stock he had used to buy the worthless shoe company would have been worth billions of dollars had he simply held on to it. The Dexter Shoe saga is a painful but powerful lesson. The sell signal isn't a red arrow on a chart. It's the dawning realization that the wonderful business you thought you owned no longer exists. The psychological demon that Buffett had to overcome in the Dexter shoe situation is one of the most powerful and destructive biases in finance: commitment and consistency bias, also known as escalation of commitment. Our brains are wired to want to be consistent with our past decisions and public declarations. When we buy a stock, we are making a decision and, in a sense, declaring that we believe in the company. If the investment starts to go sour, admitting we were wrong creates cognitive dissonance, a state of mental discomfort. To avoid this discomfort, we tend to double down on our original decision, convincing ourselves that it was the right choice and that things will eventually turn around. We escalate our commitment to a failing course of action. This is compounded by the sunk cost fallacy, the irrational belief that we must continue a venture because of the resources, money, time, or in Buffett's case, precious Berkshire stock, that we've already invested. We think, I can't sell now, I've put too much into it. Buffett's genius is his almost inhuman ability to short-circuit this bias. He is ruthless in his intellectual honesty. The moment the facts show that his original thesis is invalid, he mentally severs his commitment. He doesn't care about the sunk cost. That money is gone. The only thing that matters is the future prospect of the business. By openly admitting his Dexter mistake, he is demonstrating a rare and powerful skill: the ability to update his beliefs in the face of new evidence, even when it is painful and embarrassing to do so. He prioritizes future returns over his own ego, a trait that is vanishingly rare on Wall Street and in human nature generally. To operationalize this principle, we need a systematic way to check if our business story is still intact. We can call this the moat erosion checklist, a disciplined process to run on each of your holdings at least once a year. It's your defense against the powerful pull of commitment bias. The first step is to pull out your business owner's journal and reread your original investment thesis. This regrounds you in your initial, rational state of mind. Step 2. You must ask a series of hard questions. First, has the company's primary competitive advantage been permanently impaired? Be specific. Did they lose a key patent? Has a new technology emerged that makes their product obsolete? Has their brand suffered irreparable damage? A bad quarter is not a permanent impairment. A fundamental shift in the competitive landscape is. Step 3. Has the management team's integrity or competence come into question in a fundamental way? Are they playing accounting games? Have they made a series of disastrous capital allocation decisions? Remember, when you invest, you are hiring that management team to work for you. If you would fire them for incompetence or dishonesty, you should consider selling your stake. Step 4. Has the long-term economics of the entire industry permanently changed for the worse? This is what happened to Dexter Shoe. Think about industries like print newspapers, video rental stores, or taxi medallions. Sometimes, the entire pond dries up. It doesn't matter if you own the best horse and buggy company, if the automobile has been invented. Finally, step 5 is a proactive measure. Conduct a pre-mortem. When you first buy the stock, write down the answer to this question. If this investment completely fails in 5 years, what would be the most likely reason? This forces you to identify the key risks up front. Then, your ongoing job is to monitor for those specific risks. If your pre-mortem identified disruption from a new technology as the main risk, and a formidable new technology appears, your sell alarm should be ringing. The antithesis of this disciplined approach is what we can call the path of the hopeful holder. This is the investor who confuses a falling stock price with a buying opportunity in a business whose fundamentals are collapsing. They are the ultimate victim of commitment bias. They buy a company, let's say a retailer like Sears a decade ago, based on its past glory. They remember it as the dominant force in American retail. The stock price starts to fall as online competition from companies like Amazon dismantles its business model. The hopeful holder, anchored to their initial belief, sees the falling price and thinks, "It's on sale, I'll buy more." They are averaging down. They tell themselves stories. It's a classic brand, it will come back. They're just going through a rough patch. They read company press releases that promise a turnaround plan, and they cling to that hope. They ignore the clear evidence from the moat erosion checklist: declining market share, crumbling margins, a management team that is clearly out of its depth. Their commitment to their initial decision blinds them to the new reality. They hold the stock as it falls from $50 to $10 to $1 and eventually to $0. They didn't sell because their identity was wrapped up in being right about the investment. They held on to a broken story out of hope, and in doing so, they rode a dying business all the way to the graveyard. The difference between Buffett and the hopeful holder is that Buffett is loyal to the business, not the stock. The moment the business breaks, his loyalty ends. The hopeful holder is loyal to the stock and their own ego, even as the business sinks into the abyss. The financial statements are the ultimate report card for a business's story. This is where the direct financial connection becomes undeniable. A company with a strong and widening moat has a beautiful set of financials. It will typically show high and consistent return on invested capital, or ROIC, meaning it generates a lot of profit from the assets it uses. It will have stable or rising gross margins, indicating it has pricing power and isn't fighting a purely price-based war with competitors. It will have low debt because a profitable enterprise generates more than enough cash to fund its own growth. Now look at the financials of a company whose story is breaking. You will see the erosion in real time. The ROIC will start to decline year after year as competition eats away at profits. Margins will shrink as they are forced to cut prices to keep customers. Debt will often pile up as they borrow money to stay afloat, a desperate attempt to fund a failing business model. The stock price is a lagging indicator. The financial statements are the real-time evidence. By the time the story of Sears' decline was a major headline, the decay was already evident in its financial reports for years. An investor who performed a regular checkup using the moat erosion checklist would have seen the falling returns, shrinking margins, and piling debt, and recognized that the competitive advantage was gone. They would have sold based on the deteriorating business fundamentals, likely long before the stock entered its final death spiral. This is the essence of true stock analysis, using the financial data to verify or invalidate your investment story. It is the unemotional, quantitative proof that separates a disciplined sale from a panicked one. We have now established the two pillars of the Buffett selling philosophy. First, you are a business owner, not a stock trader. Second, you only sell that business when its long-term fundamental story is broken. This covers the vast majority of selling decisions. However, it naturally leads to a very challenging question. What if you own a wonderful business, one whose story is perfectly intact, but its stock price has soared to what seems like an astronomical valuation? The talking heads on television are screaming that it's overvalued. Your friends are telling you to take some profits off the table. Your brokerage account shows a massive gain, a tempting pile of money that you could lock in with a single click. This is perhaps the most difficult test of an investor's discipline. And Buffett's approach here is radical in its simplicity and patience. He teaches us that price by itself is a seductive liar. The decision to sell should almost never be based on the price of the stock, but on the value of the business. The story of his steadfast holding of Coca-Cola through the height of the dot-com bubble is the ultimate masterclass in ignoring the siren song of price. The late 1990s were a time of wild speculation. The internet was new and exciting, and any company with .com in its name was soaring to unbelievable heights. Old economy stocks, the reliable, profitable businesses that Buffett favored, were considered dinosaurs. They were boring. They were being left in the dust. One of Berkshire Hathaway's largest and most famous holdings was the Coca-Cola Company. By 1998, Berkshire's initial $1.3 billion investment in Coke made about a decade earlier, had ballooned to be worth over $13 billion. The stock was trading at nearly 50 times its earnings, a valuation that was, by historical standards, extremely high. Wall Street, caught in the frenzy of the new paradigm, was starting to turn on Buffett. He was openly mocked in financial publications for being out of touch, a relic who didn't understand the new world of technology. The pressure on him to sell Coca-Cola and redeploy the capital into the hot tech stocks of the day was immense. The argument was simple and seductive. Warren, you've made a fortune. The stock is clearly overvalued. Sell it, take your profits, and put that money to work in something with more growth. It was the conventional wisdom of the day. But Buffett did not sell a single share. Why? He applied his two core principles. First, was he a business owner? Yes, he understood Coke intimately. He knew its brand power, its global distribution, its simple, profitable business model. Second, was the fundamental story of the business broken? Absolutely not. In fact, it was stronger than ever. People all over the world were drinking more Coke every year. The company was a cash-gushing machine. The moat was wide and deep. The only thing that had changed was the price. The stock market, in its manic phase, had decided to place a very high valuation on this wonderful business. Buffett's logic was simple. Why would he sell a truly exceptional business, one he knew and trusted, just because someone was willing to offer him a temporarily silly price for a small piece of it? To do so would be to violate his core identity as a business owner. He would be letting Mr. Market's manic mood dictate his long-term strategy. He also understood that selling would trigger a massive tax bill on his enormous capital gains, immediately shrinking his capital base. So he did the hardest thing in investing. He did nothing. He sat patiently while the world called him a fool. And what happened? The dot-com bubble burst spectacularly. The high-flying tech stocks collapsed, many going to zero. Coca-Cola's stock price did fall from its lofty peak, but the business itself kept humming along, producing billions in profits. Because he never sold, he never paid the massive tax bill, and Berkshire continued to own a piece of one of the world's greatest businesses. His patience was vindicated, proving that a high price is a terrible reason to sell a great company. The psychological traps that Buffett avoided are deeply embedded in our financial DNA. The first is anchoring bias. We tend to rely too heavily on the first piece of information offered, the anchor, when making decisions. For most investors, the purchase price of a stock becomes a powerful anchor. If the stock goes up significantly from that price, they feel an overwhelming urge to sell and lock in the gain, because their entire perspective is anchored to their starting point. They see it as a, quote, 50% profit, rather than seeing it as continued ownership of a great business that just happens to be valued more highly today. The second and more powerful bias is the disposition effect. This is the statistically proven tendency of investors to sell assets that have increased in value, while keeping assets that have dropped in value. We are eager to realize gains, but reluctant to realize losses. Selling a winner makes us feel smart and successful. It gives us a jolt of pleasure. Holding a loser allows us to avoid the pain of admitting a mistake. This effect leads to the classic, disastrous investment strategy of cutting the flowers and watering the weeds. Investors sell their best-performing companies far too early and hold on to their worst-performing, fundamentally broken companies for far too long. Buffett does the exact opposite. He holds his winners for decades and is ruthless about selling his mistakes once he identifies them. He is farming a garden of wonderful businesses, and he has no interest in selling his most beautiful flowers just because they have grown tall. To combat these biases, we need a practical framework that separates price from value. Let's call it the valuation versus price framework. It's a mental model for making rational decisions when a stock's price becomes volatile. Step 1. Before you buy any stock, you must calculate a conservative estimate of the business's intrinsic value. This is the true, underlying worth of the business, based on its future cash flows. This calculation, your intrinsic value estimate, becomes your new anchor. It replaces your purchase price as your primary point of reference. Step 2. You must create a hard and fast rule. Price is just noise. You are not allowed to sell a stock whole because it has reached an arbitrary price target, like going up 50%, or fallen by a certain percentage, like a 20% stop loss. Any sell decision must be triggered by a re-evaluation of the business's intrinsic value, prompted by your moat erosion checklist. Step 3. If a stock you own soars in price, your first action is not to open the sell ticket. Your first action is to ask 2 questions. Has the intrinsic value of the business also increased to justify this price? And, is the market now pricing in a future that is unrealistically optimistic, thereby eliminating my margin of safety? If the price reflects a truly absurd level of optimism, for example, a valuation that would require the company to grow faster than the entire global economy, only then might a sale be considered. But even in this extreme case, the default action is to hold, because great businesses often exceed even the most optimistic expectations over the long run. Step 4. If a stock you own drops sharply in price, your action is not to panic sell. Your action is to ask, has the intrinsic value of the business also dropped, or is the market simply offering me a chance to buy more of this wonderful business at an even more attractive price? This framework forces you to always return to the anchor of business value, insulating you from the emotional whims caused by price movement. Let's examine the paths of the 99% who fall victim to price-based decisions. First, meet the profit taker. He buys shares in a fantastic, growing company for $20. Over the next 2 years, the company executes its business plan perfectly, and the stock rises to $40. The profit taker feels like a genius. He sells his entire position, patting himself on the back for locking in a 100% gain. He then watches in agony as that same company, which continues to be a fantastic business, goes on to be worth $400 a share over the next decade. His short-term feeling of victory cost him a life-changing fortune. He cut his most beautiful flower. Next, meet the stop-loss slave. She buys shares in an equally great company for $50. She is disciplined, she thinks, so she sets a hard stop-loss at a 15% decline. A few months later, the entire market has a sudden, sharp correction, a completely normal and healthy occurrence. Her stock, along with every other stock, temporarily drops by 20%. Her stop-loss order is automatically triggered, and she sells her shares at $42.50, crystallizing a permanent 15% loss. A month later, the market recovers, and the stock is back at $55 and climbing. She was shaken out of a wonderful long-term investment by a temporary market tantrum. Both the profit taker and the stop-loss slave made the same fundamental error. They outsourced their decision-making to the irrational, manic-depressive Mr. Market. They allowed meaningless price fluctuations to sever their ownership of a great business. The direct financial impact of this flawed price-based selling is devastating to long-term wealth building. The most obvious impact is taxes. When the profit taker sold his stock after 2 years, he had to pay long-term capital gains tax on his entire 100% gain. Let's say that tax was 15%. His $100 profit is immediately reduced to $85. He now has less capital to reinvest than he thinks. Buffett, by holding Coca-Cola, deferred that tax bill indefinitely. That tax money, which the profit taker sent to the government, remained inside Berkshire Hathaway, compounding for his shareholders. This concept of tax deferral is a massive, hidden advantage of a low-turnover, long-term investment strategy. Furthermore, by selling a great business, you are now faced with a new, very difficult problem. What do you buy next? The chances of finding another business as good as the one you just sold are slim. Most people who sell their winners end up buying inferior companies, effectively trading down in quality. The legendary investor Peter Lynch said it best. Selling your winners and holding your losers is like cutting the flowers and watering the weeds. Over time, this strategy guarantees you a garden full of weeds. The true financial advantage comes from finding a few truly exceptional companies and holding them for as long as they remain exceptional, allowing the power of compounding to work its magic. uninterrupted by the seductive and ultimately false signals of short-term price movements. We have established a robust framework. We think like business owners, and we only sell when the business story is broken, refusing to be swayed by the siren song of price. This disciplined inaction will protect us from the vast majority of investment errors. But there is one final, more advanced reason that Warren Buffett will occasionally sell a stock. It is not because the business he owns has gone bad. On the contrary, it may still be a very good business. He sells because he has found something demonstrably, significantly, and irrefutably better. This is the opportunity cost mandate. It is the highest and most difficult bar to clear for a selling decision. It requires comparing a great investment you already own with a potentially spectacular one you could own, factoring in all the costs and frictions of making the switch. It is a decision rooted not in fear or greed, but in a profound understanding of capital allocation and relative value. The story of Buffett's decision to sell a piece of his beloved capital cities/ABC to fund a new investment in General Dynamics illustrates this master-level thinking. In the mid-1980s, Buffett had helped finance the merger of his longtime holding, Capital Cities Communications, with the much larger television network ABC. The combined company, Capital Cities/ABC, was a media powerhouse run by one of Buffett's favorite managers, Tom Murphy. It was a fantastic business with strong competitive advantages, and it was a core holding for Berkshire Hathaway. By all the rules we've discussed so far, this was a hold forever stock. The business story was not only intact, it was thriving. But then, the world changed. The late 1980s and early 1990s saw the end of the Cold War. The Berlin Wall fell. The Soviet Union dissolved. This geopolitical earthquake sent shockwaves through the defense industry. The consensus on Wall Street was that with the primary adversary gone, defense spending would plummet forever. As a result, the stock prices of major defense contractors were decimated. They were being sold as if they were going out of business. Buffett, ever the contrarian, started looking at the wreckage. He analyzed General Dynamics, a major builder of submarines and tanks. He saw a company that the market was pricing for oblivion, but which still had massive long-term government contracts, and a new management team that was ruthlessly focused on cutting costs and generating cash. He calculated that the business was being offered in the stock market for a price that was a tiny fraction of its true intrinsic value. He was being offered a spectacular business at a ridiculously cheap price. He was now faced with a difficult choice. He already owned a wonderful business in Capital Cities/ABC, but the opportunity in General Dynamics was, in his assessment, even better. The potential for future returns from the deeply undervalued defense contractor was significantly higher than the expected future returns from the more fairly valued media company. So with surgical precision, he made the call. He sold a portion of his Capital Cities/ABC stock, a business he still loved, and redeployed the proceeds into a massive new position in General Dynamics. It was a purely rational decision based on opportunity cost. He was selling a great hand to get what he believed was an unbeatable one. His analysis proved correct. The investment in General Dynamics was a home run, generating enormous returns for Berkshire as the market eventually realized the company was far from dead. This was not selling a mistake. This was selling a success to fund an even greater success. The psychological hurdles to executing such a move are immense. The two main culprits are the endowment effect and status quo bias. The endowment effect is our tendency to place a higher value on something simply because we own it. That Capital Cities/ABC stock in Berkshire's portfolio felt more valuable to an ordinary person than cash or a new, unfamiliar stock, simply because it was already theirs. It was comfortable, familiar, and had a history of success. Selling it would feel like a loss, even if the proceeds were reinvested immediately. This is closely related to status quo bias, our natural preference for the current state of affairs. Making a change requires effort and introduces uncertainty. It's easier and feels safer to just do nothing, to stick with what you know. Overcoming these biases requires a proactive, analytical mindset. It demands that you constantly and unemotionally evaluate your current holdings not just on their own merits, but in relation to all other potential investments available in the market. Buffett is a master at this. He sees his portfolio not as a collection of beloved heirlooms, but as a fluid pool of capital that must always be deployed in the most rational, highest return manner possible. He feels no sentimental attachment to a stock certificate. His only loyalty is to the optimization of Berkshire's long-term value. This leads to our most advanced mental model, the superior alternative test. This is a rigorous, multi-step process that should only be used when contemplating a sale based on opportunity cost. Because it is so difficult to execute correctly, it should be used very, very sparingly. Step 1. You must identify the new potential investment and perform the same deep, fundamental stock analysis you would for any new purchase. Calculate its intrinsic value and determine its margin of safety. Step 2. You must honestly compare the expected future rate of return of this new investment with the expected future rate of return of the current holding you are considering selling. This requires you to reevaluate your current holding as if you were thinking of buying it today. Step 3, and this is the most important rule. The new opportunity cannot be just slightly better. It must be overwhelmingly, demonstrably superior. Buffett has used the analogy of a high bar that a new idea must clear to dislodge an existing one. Charlie Munger speaks of it as having a much better opportunity. There is no hard number here, but the gap in expected returns must be significant enough to compensate for the risk that you might be wrong in your analysis of the new company. Step 4. You must explicitly calculate the tax impact. When you sell your current holding, you will trigger a capital gains tax. This is a guaranteed, immediate loss of capital. The expected return from the new investment must be so much higher that it not only clears the high bar of being a better business, but it must also be high enough to pay the tax bill and still come out significantly ahead. This tax hurdle is a powerful mathematical force that favors inaction. The antithesis of this disciplined high-bar approach is the path of the grass is always greener investor. This person is a chronic portfolio churner. Their investment strategy is driven by FOMO, the fear of missing out. They read an article about the boom in artificial intelligence and immediately sell their solid, profitable consumer staples company to chase a hot, unproven AI stock. They don't do a deep analysis of the new company. Their research consists of reading a few headlines and seeing a stock chart that is going up. They are constantly jumping from one trend to the next, convinced that the next stock will be the one. They don't understand the concept of a high bar for new investments, nor do they factor in the crippling effect of taxes. Each time they sell, they send a chunk of their capital to the government, and each time they buy, they pay a transaction fee. They are in a perpetual state of motion, but they are going nowhere. They mistake activity for achievement, and their portfolio reflects this. They never allow any of their investments to sit and compound for any meaningful length of time. They are essentially paying a massive, self-imposed tax on their own impatience, ensuring that their wealth-building journey is constantly being reset to square one. The direct financial connection here is best understood through the lens of business quality metrics like return on equity (ROE) and return on invested capital (ROIC). These metrics measure how effectively a company's management is at generating profits from the capital entrusted to them. A great business might consistently generate an ROIC of 20% or more. A good but not great business might generate 12%. Let's create a simple scenario. You own the good business with a 12% ROIC. You identify a potential new investment, a great business with a sustainable 20% ROIC, and it's trading at a fair price. The superior alternative test might suggest a switch is in order. But now, we must factor in the tax hurdle. Let's say your current holding has doubled in value, and your capital gains tax rate is 20%. If you sell, 20% of your profit is immediately confiscated. This means your new investment, the one with the 20% ROIC, has to first make back that 20% tax loss before you even break even with where you would have been by simply doing nothing. This mathematical reality dramatically raises the bar for making a change. It shows, in cold, hard numbers, why the default decision must be inaction. Unless the new opportunity is so spectacularly better that it can clear the high business quality bar and tamp the punishing tax hurdle, the most profitable and rational decision is to simply hold on to the good business you already own. This forces a level of discipline that is antithetical to the hyperactive nature of modern financial markets, and it is a cornerstone of the massive wealth Berkshire Hathaway has built. We have now constructed the complete architecture of Warren Buffett's selling philosophy. It is a fortress of logic, built on 4 pillars. Think like a business owner. Sell only when the fundamental story is broken. Ignore the seductive lies of price, and only consider a change for a demonstrably superior alternative after clearing the punishing hurdle of taxes. And yet, all of this logic points to a profound, almost radical conclusion. The most powerful principle of all, the one that underpins the entire structure, is the advantage of doing nothing. The final pillar is the deep, abiding power of almost never. In a world that screams for action, that rewards hyperactivity with attention and praise, the ultimate investing superpower is the discipline of inaction. The default setting for a great business, bought at a fair price, is to be held. Not for a year, not for a decade, but for as long as the business remains great. The engine of wealth creation isn't brilliant trading. It's the uninterrupted compounding of capital in wonderful enterprises. And the most perfect, tangible example of this in the entire Berkshire Hathaway story is a small, simple, and utterly delicious business, See's Candies. In 1972, long before Berkshire Hathaway was the behemoth it is today, Warren Buffett and Charlie Munger were presented with an opportunity to buy See's Candies, a beloved West Coast producer of boxed chocolates. It wasn't a high-tech company. It didn't promise to change the world. It was, in many ways, a boring business. But Buffett and Munger saw something special. They saw a company with a fanatically loyal customer base. They saw a brand that commanded respect and allowed the company to raise its prices year after year without losing customers. This pricing power was a symptom of a powerful moat. People weren't just buying chocolates, they were buying a feeling, a tradition, a trusted gift. Buffett and Munger paid $25 million to acquire the company. At the time, See's was earning about $4 million pre-tax, so they paid a price that seemed high to many observers. They were criticized for overpaying. And then, they did the most brilliant thing of all. They did almost nothing. They kept the existing management. They didn't try to radically change the products. They simply allowed this wonderful business to continue being a wonderful business. Year after year, See's Candies sent its profits back to Berkshire headquarters in Omaha. Buffett and Munger then took that cash and redeployed it into other great investments. The initial $25 million investment was paid back in just a few years. Since then, See's has generated over $2 billion in profits for Berkshire Hathaway, all of which has been sent to Omaha to be reinvested. That is an 80-fold return on the initial purchase price, and that doesn't even count the compounding that occurred when those profits were put to work elsewhere. See's Candies became the prototype for the kind of business Buffett loves to own. It required very little new capital, it gushed cash, and it had a durable competitive advantage that has lasted for half a century. And the key to unlocking this incredible financial result was the discipline to never sell it. Had they sold it after it doubled or tripled in value in the 1970s, they would have felt smart for a moment, but they would have forfeited billions in long-term, tax-efficient profits. See's Candies is the living embodiment of Buffett's favorite holding period, forever. It is the ultimate proof that the most profitable action is often no action at all. The psychological force that makes this so difficult for most people to emulate is called action bias. Humans have an innate tendency to favor action over inaction, even when inaction is the more rational course. When faced with uncertainty or a perceived problem, like a volatile stock market, we feel a deep-seated need to do something. Sitting on our hands feels passive, irresponsible, and lazy. The financial news industry is built on feeding this bias. Every day, it creates a sense of urgency. a feeling that you must react to the latest economic data or geopolitical event. This pressure to act is immense. Resisting it is not a passive act. It is an active and powerful form of discipline. It requires overriding a deep-seated instinct. It also requires a profound capacity for delayed gratification. The thrill of taking a profit is immediate. The reward of long-term compounding is abstract and decades away. To choose the latter over the former is to choose the marshmallow tomorrow over the marshmallow today. It is a test of emotional maturity. Buffett's genius is not just his analytical ability, but his supreme mastery over his own psychological impulses. He has cultivated a temperament that is perfectly suited to exploiting the action bias of others, patiently holding his assets while the rest of the world frantically trades around him. So how can we cultivate this discipline of inaction in our own financial lives? The blueprint is the portfolio hibernation strategy. It's a system designed to protect you from your own worst enemy, yourself. Step 1. The heavy lifting must be done up front. Your primary job is to build a portfolio of high-quality businesses that you understand, bought at fair prices. Once this initial difficult work is complete, your ongoing job shifts from active management to patient observation. Step 2. You must schedule your interactions with your portfolio. Put your quarterly business review on the calendar, the one time you will run through your moat erosion checklist. Outside of these scheduled check-ins, you must create deliberate friction that prevents you from acting impulsively. Step 3 is about curating your information diet. Unsubscribe from the newsletters that scream buy or sell every day. Delete the stock market app from your phone's home screen, or at least move it to a folder where you won't see it every time you unlock your device. You want to starve your action bias. Step 4 is to redirect your energy. Instead of watching stock quotes, spend that time learning about business. Read the annual reports of companies you admire. Read biographies of great business leaders. Study industry trends. The more you understand about what makes a great business, the better you will be at identifying them, and the more conviction you will have to hold them through thick and thin. Step 5, and this is a crucial reframing, is to measure your success differently. Don't measure it by the short-term percentage change in your portfolio value. Measure it by the long-term operating results of the businesses you own. Are their earnings growing? Are their margins expanding? If the businesses are succeeding, your investment will eventually follow. This strategy transforms investing from a high-stress daily activity into a calm, long-term project, much like tending a garden. The polar opposite of this approach is the path of the hyperactive hedge fund wannabe. This is the investor who believes that success is directly proportional to activity. Their life is a whirlwind of financial inputs. They have multiple screens showing charts and news feeds. They wake up to check pre-market futures. They listen to financial podcasts on their commute. They have alerts set for dozens of stocks. They believe that by consuming more information and making more trades, they are gaining an edge. They might even delve into complex option strategies, believing that complexity equals sophistication. But what they are really doing is generating a massive amount of frictional costs. There are the obvious costs: commissions on every trade, the bid-ask spread every time they buy or sell, and the massive tax bills from short-term gains. But the hidden costs are even more damaging. The constant decision-making leads to mental fatigue, which is a breeding ground for emotional errors. They are perpetually reacting, never thinking. They mistake the frantic motion of trading for the slow, steady progress of investing. They are playing a loser's game, constantly fighting against the powerful currents of compounding and taxes, all because their action bias has convinced them that being busy is the same as being productive. The direct financial connection of the inaction advantage is the most powerful force in the universe of finance: compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Let's use a visceral, undeniable example to illustrate its power. Imagine two investors, both starting with $50,000. Investor A, our patient business owner, invests in a basket of great companies that deliver an average annual return of 10%. For the next 30 years, she follows the portfolio hibernation strategy. She does nothing. Investor B, our hyperactive trader, invests in the exact same basket of companies. But he's a tinkerer. He tries to time the market. He sells when he gets nervous and buys back in when he feels confident. Over 30 years, his frantic activity means he just happens to be out of the market during the 10-some best trading days of that entire period. Just 10 days out of more than 7,500. At the end of 30 years, investor A, who did nothing, sees her $50,000 grow to over $872,000. Investor B, who was busy trading and missed just those 10 best days, his final sum is only about $430,000. He did twice the work for half the reward. The cost of his activity was over $400,000 in lost gains. This is the staggering financial power of staying put. The secret sauce to wealth building is not genius-level timing or complex strategies. It is ownership of great assets, combined with the one ingredient that is most scarce in the modern world: uninterrupted time for your capital to compound. This is the final promise of Buffett's philosophy. It is the ultimate financial advantage, and it is available to anyone with the discipline to simply and powerfully do almost nothing. You have just spent your valuable time absorbing a framework that has generated hundreds of billions of dollars in wealth. You now possess the single most important decision-making tool in the Berkshire Hathaway arsenal, the business owner's sell discipline. You have moved beyond the amateur's frantic question of when to take profits or cut losses, and have ascended to a higher level of thinking. You now have a clear, logical, and unemotional system for knowing when to hold on, and when it is finally truly time to let go. This is a permanent upgrade to your financial mind. But this framework, this clarity on when to let go, is only one pillar in a much larger structure. It is a defensive strategy of profound power designed to protect your capital from your own worst impulses. It tells you when to clear a space in your portfolio, but it doesn't fully illuminate the offensive genius of how Buffett identifies the masterpieces to put there in the first place. The ability to distinguish a temporary bargain from a permanent value trap, the tools to analyze a balance sheet to find a hidden moat, the skill of calculating a company's true intrinsic worth, these are the other side of this coin. They are the interlocking pieces of a complete system for wealth creation. The video that is now appearing on your screen is the next part of that map. It is not a random recommendation. It is the link that connects the discipline of selling with the art of buying. It builds upon the foundation you have just laid, taking you deeper into the mind of the world's greatest investor. The journey of transforming yourself from a market participant into a true capital allocator is a step-by-step process, and this is the next logical step. You have already proven that you are not a speculator. You have invested the time and the focus to learn a principle that 99% of market participants will ignore their entire lives. You have chosen clarity over chaos. The question now is, are you ready to complete your mental toolkit? To move from simply protecting your capital to actively and intelligently compounding it? The choice to continue that ascent, to build the next pillar of your financial fortress, is yours. The next piece of the puzzle is waiting.